Right, let's have a session on theme 2 for Edexcel. Let's go. So first thing to think about is business growth. So you've got internal growth, which is sometimes called organic growth. Internal growth is about entering new markets, that's new geographical regions, or new products. That could be because you did some sort of innovation or research and development, R&D, or because you utilise your new technology that you've got. It's less expensive usually versus external growth, but it's slower or riskier, as you're not buying a ready-made business or success. And external growth, sometimes called inorganic growth, is essentially you do an acquisition, a merger or a takeover. So you just buy a ready-made business. It's more expensive, but it's faster in terms of entering a particular market or particular region. Now, you might be a growing private limited company and then you turn into a public limited company, a PLC. You do that through a flotation and that will raise you enormous finance because you're going to get lots of individuals that will buy shares in your public limited company when you're on the stock exchange. And then you can use that enormous finance to expand your business into new markets, into new products and so forth. Now, a growing business likely will get economies of scale. So a growing business means more output. More output means you get economies of scale, probably purchasing economies of scale, bulk buying essentially. And if you get purchasing economies of scale, that will lower your average cost per unit, per one, which will maybe allow you to lower your prices lower than your rivals, which will give you a competitive advantage. Number 2 is sources of finance. So you've got internal sources of finance, examples there being retained profits. Retained profit is the portion of a company's net profit that is not paid out to shareholders via dividends. Then you've got selling assets. Selling assets is usually selling long-term assets like equipment, like machinery, but you've got to be cautious of not selling too many assets, otherwise you'll have no business. And then on the external side, you've got loan capital, which is essentially just bank loans. So it's money that a business borrows from a lender, such as a bank, for a specific period of time, and you pay interest on that. So obviously now we have interest rates that have been increasing every month for the last year. That will mean higher costs for having loan capital. Now, the opposite of loan capital is share capital, sometimes called flotation, as I mentioned before. If you become a public limited company, that's essentially capital, money you get from selling shares. Share capital is the money that a company raises by selling shares to investors. Number 3 is why business aims and objectives change as the business evolves. Well, you might have changes in market conditions, changes in technology, changes in the financial performance of a business. Maybe it starts doing better or worse, and there's changes in legislation or laws. So that's why your objectives might change as you evolve. The next thing is how they may change as the business evolves. So you may choose to focus on survival or to choose to focus on growth. You may choose to enter a market or exit a market. You may increase or reduce the size of your workforce, how many employees you got. You may increase or decrease the size of your product range, how many products you sell. Next thing to think about is business and globalization. What is globalization? Well, it's the world becoming more interconnected, so there's more trade. And when we think about trade, we're thinking about imports and exports, so it's led to both of those. Now, the impact of imports on businesses, let's think UK businesses, is that if there's imports, UK businesses have competition from overseas because customers no longer just buy from your business, the domestic business, they might buy from abroad. So that gives you competition, but it means you can use the importing from the other countries, businesses, to buy components, buy supplies from abroad. Sometimes they might be cheaper or of better quality. On the export side, if you're a UK business and now there's globalization, that means you can sell abroad to overseas customers. And that gives you a bigger market size and potential sales. It may lead to new locations for sales or for production. And this would make you a multinational company, an MNC. Next thing to think about with business and globalization is considerations for multinational companies. So you might have to consider the fact you're going to have a tariff. Now, a tariff, let's just say that you are a UK business and you want to sell to the US, but the US put tariffs on foreign sales and you're UK, so you're foreign. Well, that will mean that when you sell your goods in the US, there's going to be higher prices for you. So that's going to mean your demand is reduced because your higher prices. So lower demand means you're less able to compete. You might lose your competitive advantage when you sell into that country, being the US. Also, trade blocks are of importance. So a multinational company may want to locate in a country that is within a trade block, such as in Europe, the European Union, or in Asia, you've got ASEAN. And then you want to go into that trade block, and then it gives you access to the members of that trade block, because there's going to be free trade between the members and there'll be no tariffs in that case. How multinationals compete? Well, they compete on e-commerce and they might adapt their marketing mix. Next thing to think about is the ethics trade-off, ethics versus profit trade-off, to be clear, because sometimes, but not always, by being more ethical, that's doing morally the right thing, may lead to higher costs or higher prices, meaning profits fall. So more ethical equals less profits, maybe. There's also a sustainability or environmental trade-off. So the sustainability versus profit trade-off is that sometimes, but not always, by being more sustainable, using renewable resources, for example, may lead to higher costs because of new technology you need to bring into the business, but it might mean that profits fall. So more sustainable might mean less profits, maybe. Next thing to think about is pressure groups. So that's an organised group of people trying to influence governments or businesses. How a pressure group might impact a business? Well, it might mean the pressure group is successful in changing the business's marketing mix. So we're thinking the 4 Ps here. So it could be it might influence the business to change its product. Maybe it's a green pressure group, like Greenpeace, for example. And it might mean the business is pressurised into considering different raw materials that it might use or different energy within its factories. That might impact on its prices. It might be that it costs more, therefore, to bring in that machinery or use those sustainable resources, which means the cost of production have gone up, which means the business might need to put the prices up, so more expensive, and that would adapt the P within the marketing mix. And it could also be, of course, place or promotion could be influenced. Next thing to think about is the marketing mix. The first of the 4 Ps is product. First question here is the design mix. So you're thinking when you're considering the design of your product in the research and development stage of the product life cycle, you're thinking about aesthetics, how it looks, function, does it do what it's supposed to do, and does it make economic sense in terms of making it for what you're likely going to be charging based on your market research. A way to think about it is AFC, Arsenal Football Club. Product life cycle, we're thinking about R&D stage, and then you move into the introduction stage, the growth stage, the maturity stage, and then the decline stage. Let's think about each one in a bit more detail. So the research and development stage, you probably do lots of market research there, lots of product development there, so you're going to have lots of costs and no sales. So you're going to have a cash flow issue in the R&D phase. Then if your business is successful, it will move into the introduction phase. It doesn't have to move for all the stages. So it moves into the introduction stage, likely low sales, unless of course you've got lots of brand awareness, lots of initial awareness. And then you'll move into the growth stage. In the growth stage, you're going to see the fastest rate of growth in your sales. Sales are increasing super fast. You might need to continue that by advertising lots, but you're likely to see lots of rivals in the growth stage because they are seeing that your sales are growing fast. They'll keep growing fast until they reach their peak, and their peak is when you're in the maturity stage, sometimes called saturation. And then you unfortunately might move into the decline phase. Decline phase, you still have sales, but they're just slowing down. And the way to stop yourself going into the decline phase and try and remain in the maturity phase as long as possible is to employ extension strategies. So when we're thinking about extension strategies, here are some useful extension strategies to be aware of. Improve packaging, but then you need to think about the cost of improving the packaging. Will it be effective? Are you combining it with some sort of segmentation change? You might add new or more features to the product, but what's the cost of this? Is there lots of R&D costs here? Will it appeal to the target market by doing that? Will it lead to higher prices because you've got to recoup those R&D costs? New target market, maybe you think about segmentation here, changing the location, the income, the demographics. It's common for businesses to work down the income segments, but it also could be that you expand geographically. You need to just think about what the issues there in terms of that type of segmentation you do. Are there any new costs, for example, associated there in that extension strategy? Then you've got to think about advertising as another extension strategy. Just do more, but then you need to think about what type of advertising you're going to do. Are you going to go advertising in terms of billboards, magazines, internet, newspaper, television? And then you could reduce your prices, but if you reduce your prices, you'll want to think about how sensitive the demand will be to lower prices. Example, you lower your prices by 10%, you'll want your demand to increase by more than 10% to have larger amounts of revenue. Continuing on with the product differentiation, so about your products being different, sometimes called USP. So benefits there of having a differentiated product. It improves brand image, brand awareness. It might improve customer loyalty, therefore increasing sales, leading to reduced marketing costs because everybody's aware of your product being so super duper. Next thing in terms of the P's is price. Let's just go from basics, 101 stuff, the law of demand. So if prices go up, demand goes down. But in longers, you need to think about the extent. For example, if prices are going up by 10%, yeah, demand falls. But what if it only falls by 1%? That will mean more revenue overall, hence the happy face. So the extent of changes in demand compared to what you've done in prices is a super evaluation point to score big. Next thing in terms of price is pricing strategies. So price skimming is when you start at a high price and then you reduce the price over time. You'll do that if you've got brand awareness or if there's no one else that's a rival to your product in the market. Advantages of this, you'll recoup your research and development costs, particularly if you're able to get away with those high prices for a long amount of time. Disadvantages, you might alienate your customers who are not willing to pay that higher price, or if they know what you're up to, they might just wait until you lower your prices. Price penetration is the opposite of price skimming, so you start low and then you increase those prices over time. We've had that with Netflix over time, where they've just increased prices year after year. You do that initially with those low prices to grow awareness in the market, encourage switching behaviour from consumers. But the disadvantage is if the product quality isn't actually there, then you'll struggle to maintain the demand when you increase those prices. So it depends on the product quality. The last one to think about is competitive pricing, which is when you set prices around the same level as your rivals. You might undercut them. But the key thing here is it's common in oligopolies where there's 4 to 6 firms that dominate a market. Advantage of doing this, maintain market share. Disadvantages, well, you need to compete on other things if you're doing competitive pricing because you've essentially set your prices the same or same abouts as everybody else. So you might want to compete on other things like USP, like product differentiation, and that might lead to more R&D. Next thing to think about is it depends on points for price strategies. So product life cycle is always a go-to evaluation point. Where are you in the product life cycle? Are you in the introduction phase? Well, in that case, you might have no awareness, so you need to use price penetration. Maturity stage, you might use competitive pricing because it's become a saturated market. Decline phase, well, you might use the product as a loss leader, being that you charge a really low price at first and then you raise it over time, an extreme version of price penetration, that is. And then next thing to think about is the level of competition, so how many rivals you've got. So you might use competitive pricing if you've got lots of rivals. You might undercut them and go lower than them. And the next thing to think about is research and development costs. So if you had really big research and development costs in the R&D stage of the product life cycle, you may need to do price skimming at first to recoup them. And that's going to be even more effective for evaluation if you have no other rivals. Then the next thing to think about is promotion. So you make customers aware of your product. You remind customers of your product. This is why you do promotion. Therefore, that increases the sales of your product. Changes the perception about your product. Sometimes you might want to adapt for different segments of the market. So that's why you might do promotion. And then the last thing is to persuade customers, of course, to buy it. Promotion, think about types of promotion. Well, you've got advertising. Advertising, think Mint, billboards, magazines, internet, newspapers, television. But you need to think about the costs of doing those. For example, television is very expensive. And it depends on what segment you're targeting because you want the people that you're targeting to buy whatever your product is, or you want them on that particular source of media. For example, if you are looking to sell to a mass market, television might make sense, even though it is expensive. Another type is sponsorship. So sponsorship, advantages here, brand awareness, disadvantages, the cost of sponsorship, the risk of who you sponsor because they might do something weird. It depends on, of course, if it aligns well with whatever your business is. And there's always a risk. Product trials, essentially samples. Well, it's going to encourage consumer switching, encourage them to try your product, but you need to think about the cost of it and the extent that you do product trials. Special offers, so you could be thinking of bog off here, buy one, get one free, for example. That's a form of sales promotion. It's short-term by nature. And then you need to think about, well, what's going to happen when that special offer finishes, when it ends? Are the consumers going to still be buying that product? It might depend on the quality of the product itself. Ultimately, that will be the important thing there in the long term. Then branding, well, that's there to reinforce perception of a product, but it requires persistence. You've got to do it a lot of times, and you've got to think about the cost of it. Next thing to think about is online promotion, the types of online promotion where you've got targeted advertising, you tailor that to the appropriate segment, but you want to question the cost there. You've got viral advertising, doesn't always work, it requires a bit of luck. Social media, well, it takes time and effort, and then you need to think about the cost of it. E-newsletters, just a question of do people actually read them? Those newsletters that often come into your email accounts, and do they just get diluted through the 10 billion emails you've already got? Next thing to think about is place within the marketing mix. So place, it's sometimes referred to as distribution because it's about how customers can buy the products. Important that you get that. So you might get products through websites, e-commerce, or through mobiles, m-commerce, and of course the channel of distribution is that they're delivered to your door. Or you might collect them from store, or you might buy them in store, or you might buy them from a retailer store that you sold your product to, or via a wholesaler who bought loads from you. Or you might be thinking about if it's telesales through the phone. So it's about how customers buy those products. Lots of different ways that can happen, and that's the place in the 4Ps. Next thing to think about is the integrated marketing mix. An important term this is essentially that all the 4Ps in the marketing mix, they need to work together. They need to be aligned. They need to be aligned for the segment that you target. I'll give you an example. You've got a high quality product. Well, if you've got a high quality product, you'll probably charge a high price. You'll be very selective about promotion and where you promote it. You'll be very selective about which retailer can stock that product. You don't want to damage the reputation of your product by doing it in a cheapened place. And you'll use that to build your competitive advantage. So if we're thinking about the marketing mix being integrated, it's important that it's dynamic and it evolves over time. So over time, that high quality product, maybe you've got lots of rivals now. Well, if you use that high price, you might have to move into the second phase of price skimming and start to lower that price. You might need to be selective about promotion, and now you need to try new segments and therefore new forms of promotion. If you were being selective about which retailer that can stock the product and you've evolved over time, now you might be working down income segments, looking to target different income brackets along the way, or you could use multi-channels of distribution. And that's that you sell in different ways to the consumer. So you might have a store, a website, you sell to a retailer, and so forth. Next thing to think about is business operations. So what's the purpose of operations? Well, it's to produce goods and to produce services. Then next thing to think about is types of production processes. So you've got job production, which is a manufacturing process in which a single product is made to order for a specific bespoke customer. There's motivational benefits here, employees like it, they're involved in the whole process, but it could lead to higher prices because of higher costs. Then on the other end of the extreme, you've got flow production. That's a manufacturing process in which a product is made continuously, 24/7 usually, on an assembly line, so using machinery, using capital, but you might get economies of scale because you're making loads of output, purchasing economies of scale, technical economies of scale. It will lower your average cost per unit. You've got lots of productivity there, and the key thing is it might lead to more competitive prices because you can make it cheaper. But it might lead to demotivated staff and a lack of flexibility as well because you're using an assembly line. If you need to make something else because consumer demands change, it will be difficult for you to adapt. Then in the middle of those two types of manufacturing processes is batch production, and that's in which a group of identical products are made at the same time, in groups, in batches. Good thing here is you've got a bit of flexibility, and it's a kind of a balance between job and flow production, and maybe gets the best of both worlds. So in job production, you get that specific nature, and you can still have a bit of that in batch production, but also you can maintain those competitive prices that you'll get out of flow production because of the economies of scale, but just to a lesser extent in each one. Next thing to think about is just in time. What is it? Well, just in time is there to reduce waste by producing goods and services only when they're needed. Benefits of just in time, well, reduce stock costs as just enough raw materials, components arrive when you need them, so it can save on storage costs. Improved efficiency, of course, through using just in time. But problems of just in time, you need to have a very good relationship with your suppliers. It requires accurate demand forecasting, and also you might lose out on economies of scale versus just in case versus buffer stocks because you're getting smaller quantities coming in. Next thing to think about is procurement. Well, procurement is the process of buying goods, raw materials, stock. And then suppliers are very important, of course, because with suppliers, you want to be thinking about hoops. You want to be thinking about quality. You want to be thinking about reliability and price. Next thing to think about is logistics. So logistics, what is it? It's the process of planning, organising, managing the flow of goods and services from the point of origin, maybe the supplier, maybe the factory, into the point of consumption, the shop maybe. In simple terms, it's transportation. So considerations you want to think about, well, the cost of your logistics department, the reputation of your logistics department. Maybe you need to get it to your customers quick, particularly if you use e-commerce, online delivery. You want to be thinking about customers being satisfied as well in terms of online deliveries, that timely delivery. Next thing to think about is quality. So why is quality important? Well, quality is important because it's going to increase your sales, attract customers, retain customers, particularly if you become reliable and dependable over time. Another reason why quality is important, it's going to reduce costs. There's no defects, there's no need for recalls, no need for refunds. That's all super for cash flow. And it's going to give the business a competitive advantage. But how do you keep high quality levels? Well, how you keep it is through QC, QA. QC is quality control. That's the process of ensuring that products or services meet customer requirements, inspections and sampling basically. But quality assurance is the systematic set of activities that are used to ensure that products or services meet customer requirements. So it might be that you do some sort of planning of how you're going to make a product that it ensures top quality. You might train your staff, and then you might have daily meetings so you can always seek to improve your production process. That's QA, quality assurance. Sales process, so you're thinking about product knowledge, service with speed you'll want within the sales process, you'll want customer engagement, you'll want to respond to any feedback you get from your customers, and then you want to give them after or post-sales service. That could be warranties, technical supports, or customer service. Why is customer service important? Well, to attract, retain customers, increase sales of course, reduce costs, less complaints if you've got top customer service, improve employee morale, build brand reputation. Next thing is finance, income statements. So you run a bagel business. Well, you've got revenue of £100. That's always at the top of the income statement. The next thing in the income statement is cost of sales. That's the direct costs involved. So if we're talking about a bagel business over there, direct costs will be the dough. There'll be, if it's a salt beef bagel, the salt, the beef. That's £20. That's a direct cost. To get your first profit, gross profit, it's revenue minus cost of sales. So here you can see it's £80 because 100 minus 20 is 80. Then you've got operating expenses and interest. That's the indirect costs, the day-to-day operational business costs. It could be insurance, it could be rent, for example. Let's just say, really silly numbers here, that's £30. That allows us to calculate our next profit, which is net profit. And net profit is, of course, gross profit minus operating expenses and interest. So 80 minus 30 is 50. That leaves us on to the next thing that's important, back to that bagel business, is ratio analysis. And those two margins you have to know. This is for sure one of these will feature. So gross profit margin, the formula there is gross profit divided by revenue times by 100. So you can see you've done 80 divided by 100 times by 100, 80%. That's the first one. The second one is net profit margin. That's net profits, £50 divided by revenue, £100 times by 100. That's 50%. Perhaps net profit margin is more useful because it accounts for both types of costs. That's the cost of sales, the direct costs, and the operating expenses, the indirect costs. But it's also useful to work out your margins because you can compare your businesses to other businesses of different sizes, and you're comparing in percentages, not in raw numbers. That might be useful to look at efficiency of sales. Next thing is investment. Types of investment, well, new machinery, new buildings, new vehicles. And then you might want to think about, in investment questions, you're probably going to be faced with the ARR formula, which is the average annual profit divided by the cost of investment times by 100 expressed as a percentage. So average rate of return is this formula, I've just said it. But the important thing is you might have to calculate that top bit, hence the white star. So average annual profit, well, the formula for that, average is just mean from maths, if you've been doing GCSE maths, which I'm sure you have been. Then average annual profit is just total profit divided by how many years. So you had total profits of £20 over how many years? 10. 20 divided by 10 is 2. Next thing to think about is using financial data. So you might use gross profit margins, you might use net profit margins, and you want to compare against yourself in previous years. Have you been trending upwards? Also, you want to compare against rivals. Are you better than the industry average? Are you better than your main competitors, your main rivals? But for a bit extra, you might want to consider the perspective of other stakeholders. So think about employees. What do they care about? They probably care about training, wages, and so forth. Customers, well, they care about prices, quality, customer services. Now let's move on to the final bit, which is HR. We'll deal with organisational structures first. So organisational structures to be aware of will be hierarchical or tall. We're thinking advantages of these structures. Well, more opportunities for promotion because there's more layers of management, better for staff motivation. Second thing to think about is staff might gain more support from their line manager because you're going to have a narrower span of control within a taller structure. And then thirdly, you might be thinking about a higher degree of supervision because of that smaller, that narrower span of control. And that might mean that line managers are just more effective. Disadvantages, well, many layers of management will mean narrow spans of control, as we said, but it could mean the chain of command is long, and that could make communication possibly slower, as instructions will take longer to travel through the different levels or layers of management in the organisation. And also it might mean they're less responsive to change in terms of the firm making decisions. It's a slow oil tanker, as it were, in making decisions, as opposed to a flatter, more nimble structure where there's fewer levels within the business, fewer layers of management. Lines of communication will be short, so the firm is perhaps more responsive to change, more responsive to making quick decisions. Staff within a flat management structure might feel more empowered, perhaps they work more independently because of the wider span of control, and that might mean they take on more responsibility. On the disadvantages side for flat structures, well, a wide span of control means that tasks are likely to be delegated. Evaluation point, who are you delegating to? Are they capable of doing it? Do they have the skills? Are they motivated to do that? But also it might be that there's less promotion opportunities within a flatter structure, and that might be an issue for staff retention. Next thing to think about in organisational structures is centralisation, which leads to consistency. It's easier for control and it's quicker decision makings. Always with centralisation, there's lots of C's there: centralisation, consistency, control. And then there's lots of D's when you think about decentralisation. So decentralisation leads to better decisions as you're making local decisions, you're decentralising it. The decisions aren't being made by a select few at the top of the organisation, it's being made at a local level. It might allow local experts to make decisions. And of course it involves delegation, all the D's there with decentralisation. Next thing is, why is effective communication important? Well, employees are more productive, employees complete the job well, and it might lead to improved motivation. Next thing, what are the barriers to effective communication? Well, if in your MNC, you're dealing in different countries, so that could lead to language barriers or cultural issues, or time zones could be a problem in terms of effective, being good communication. Next thing is different ways of working, where you've got part-time, full-time, and then flexible hours, and then permanent, temporary, and freelance in terms of your contracts. And then you're thinking using technology. Well, you might use technology like remote working, working from home essentially, and that would promote efficiency. That's why it's good. Roles and responsibilities, well, usually they're in this order: directors at the top, then senior managers, then supervisors, then operational staff, and then support staff. Next thing to think about is how businesses recruit. Well, they create documents, they create a person specification about what they want in when they recruit somebody, what do they want from that person, and then a job description, what are you likely to do in that job. And then they create an application form. It will be blank because they want you as the candidate to fill it out. And when you fill out that candidate, you'll send that document, that filled application form, along with your curriculum vitae, your CV. Next thing is types of recruitment. Well, likely it could be an internal versus external question. So internal recruitment leads to increased morale. There's more opportunities if you are recruiting from within your business. Productivity might improve. Reduce costs on advertising perhaps because you're recruiting from within your business. You can use your intranet, you can use your emails or your Teams or whatever you use in your business to try and find that next person. Perhaps because you've already worked at the business, if you're recruiting internally from inside your business, it might lead to more knowledge, more skills, and perhaps more likelihood that there's going to be a successful hire in terms of that recruitment because they're already used to the culture of your business. On the other side, you've got external recruitment. Well, that means you're recruiting from outside your business. So, of course, there's going to be a wider pool of candidates. It might lead to more or improved diversity within the organisation, which is always a good thing. And then new perspectives, or it might lead to more innovation or creativity, or just simply bringing in ideas from your rivals to your business to make you better as a business, as a firm. So that's why external recruitment might be useful as opposed to internal recruitment. Next thing is why train your workers? Well, they become more skilled and therefore more productive. And if they're more productive, it might improve efficiency, brings your average cost per unit down, gives you a competitive advantage. Become more motivated? Well, they might become more motivated as they feel more valued now because you're training them, you're offering them training courses, and that means they could become more productive and then just rinse and repeat those same chains from before. Stay with the business longer, so that's going to, if you train them up, they stay with you longer. That leads to increased staff retention, and then increased retention is clearly good because they become more experienced with you, and that could lead to efficiency gains in the future. Next thing is why motivate workers? Well, to retain your employees, and that's obviously going to be benefit there in terms of experience, but also cost. You don't need to replace them if you're retaining them. Improved productivity of your workers. And then how to motivate workers? Well, financial methods of motivation, that would be remuneration, bonuses, commission, promotion, and fringe benefits. And then non-financial methods of motivation would be job rotation, job enrichment, and autonomy. That's the end of this sesh. Best of luck. Watch out for the final sesh video for paper 2. And other than that, see you at the next sesh.